Welcome back. Couple of reminders. One is your first quiz is on Wednesday in the first 30 minutes of class. There will be class after the quiz, so don't leave if you finish your quiz early because we will continue with class. It'll cover almost through much of what we do today, but no, it'll cover everything through this session. If you plan to take the class online, you need to let me know, because the way it works is you're not going to be able to get it off Brightspace. I will send you the quiz right at the start of class, and I will collect it back when it's done by email. So now I think it's easier to take it here. So I would suggest that you just show up and take the quiz, unless you have something that you really cannot, that leads you to not be in the room. Any questions before we start on today's class? Okay, so I'm going to start with our usual start of the class test. So I'm going to start with something we covered already last session, but I want to go back to it. Now, I made this big deal about when you value a company, you want the most updated numbers you can get for pretty much every single input. And I said, don't be caught up with consistency, which is, don't tell me that your last annual report ended December 31st of 2020, and therefore you're going to be valuing the company as of January of 2021. Because there's no point. What's the point of valuing a company 12 months ago? Because you can't go back and act on it. Your valuations are as of right now. I understand that right now is a shifting target, because by the time you get to May 9th, which is your last day of class, it's a very different, you might be looking at a very different market, very different risk premiums, but you want your valuation to be updated because you want to act on your valuations. If you want the most updated numbers, let's talk about ways in which you can get updated numbers. And we talked about taking trailing 12 months, but let's look at why the alternatives that some people use don't quite work. Using the last annual report for some of you will work if your company is updated through 2021. A lot of companies in the US have already updated. When I valued the Fangam stocks, as I said, all of them had updates by the middle of February. The timeline has moved for all companies. It used to be that you could not get these annual reports or the December 31st numbers till end of March or April, now middle of February. So many of you, if you don't have it right now, will by March, will in a few weeks have it. So you can use the annual report if it's updated. Don't take the last quarterly report and multiply by 4 for obvious reasons, right? There's seasonality, and if you multiply by 4, strange things will happen to numbers. So that's a non-starter. You can, as you said, use the trailing 12-month numbers. And for many of you, if you don't have the 2021 numbers updated, go trailing 12 months, even if through September 30th of 2021, because that's the best you can do. You can even create this makeshift annual number. If you have the first 3 quarters for 2020, analysts are already estimating what the numbers will look like for 2021. I'm okay with you taking the last quarter as an estimate and adding it on. But the bottom line is, no matter what you do, you want the most updated numbers you can. Yesterday, I got an email from somebody saying, I put out my earnings post, which I sent the link to. So if you get a chance to look at it, because there's some interesting numbers as you look across the globe on margins and returns on capital. And the email said, have you updated the numbers for the Russian crisis? And I said, what exactly do you want me to do? These are accounting numbers. It's not like accountants every minute of every day update numbers. The numbers in the next quarter might reflect it, but that's a reality we face. Market numbers can be updated to this minute, right? You can get the sovereign CDS spread for Russia. It's a very different number than it was 2 weeks ago or 6 weeks ago at the start of this year. You can get T-bond rates as of right now, but the accounting numbers are always going to be a little stale. It's not your fault. Are the most updated values you can get for those accounting numbers. Any questions on updating? I'm going to ask you a generic question about capital expenditures. Before I do that, though, I want to give you the definition of capital expenditures that my accounting professor gave me when my very first accounting class. He said capital expenditures are expenditures designed to create benefits over many years, as opposed to what? Operating expenditures, which create benefits only in the current year. So keep that definition in mind as I'm going to list out a bunch of items, and I want you to tell me whether they'd fit into this generic definition of capital expenditures. Building a manufacturing plant. That's a slam dunk, right? Accountants have always dealt with that as Capex. How about R&D expenses? Clearly, if you define it as expensive benefits over many years, it might be uncertain, but as we'll see, that's a very weak defense of using it as it is a capital expenditure with uncertain benefits. How about advertising by a consumer product company? Maybe, right? For some, it's of course designed to get you to buy more Doritos during the Super Bowl. But for some advertising, it's got nothing to do with you buying more stuff. Now it's building a brand name. So if you're a consumer product company and your biggest asset is a brand name, you could argue that a chunk or a portion of the advertising that Coca-Cola spends is really like Capex. How about recruiting and training expenses at a consulting firm or an investment bank? I mean, think about it. You go to work, you look at McKinsey, you look at Goldman Sachs, the biggest asset is human capital. And if you think about human capital as the biggest asset, you could argue that some of the wages you pay are clearly to get income right away, but some of this is designed to keep you working for multiple years, derive value in the future. You could argue that recruiting and training expenses are really also a chunk of Capex for these firms. What I'm trying to say is the accounting definition of Capex is kind of stuck in the 20th century. Manufacturing companies, it's really not reflecting the kinds of companies we see out there. Think about all the companies that have gone public in the last decade. Very few are manufacturing companies. The Palantirs, the Airbnbs, the Ubers, the Facebooks of the world. What we call Capex doesn't really fit easily into any of those traditional Capex definitions. Part of what we'll talk about today also is a tax rate, because you got to take your operating income and adjust it for taxes. And we'll talk about two different tax rates. The tax rate you will see actually reported by companies is called an effective tax rate. It's really an average tax rate paid across all your income. And when we talked about the cost of debt, we said don't use the tax rate. The tax rate you should be using is a marginal tax rate. But in the context of calculating after-tax operating income, I'm going to come back to this question. The cost of debt, it's a no-brainer. It has to be the marginal tax rate. When we talk about a tax rate to apply on all of your income, you can already see the question gets opened up again, right? You can't use the marginal tax rate because you don't pay the tax rate, that tax rate on all of your income. Can you get away using the effective tax rate? So one of the things we'll talk about is why effective tax rates and marginal tax rates vary for companies, and when you might be okay using the 16% effective tax rate that Apple reports in 2021 as the tax rate for the future, and when you should be moving that tax rate towards the 25% or the 27%, that's the marginal tax rate for US companies. So lots of different issues, Capex, working capital, tax rates. So let's get the process started by going back and where we left off on Wednesday. So you remember my rationale for why lease commitments are debt, right? Now accountants have come to that conclusion as well. And the process of converting lease commitments to debt is a very straightforward process. You take the contractual commitments you have. So these are not expected lease payments. These are contractual lease commitments for the future. which companies have reported for a long time. You discount them back to the present using the pre-tax cost of debt as a discount rate. Somebody remind me again, why do we use the pre-tax cost of debt to discount those commitments to get? Why don't we use the after-tax cost of debt? Well, it's not just that. These lease commitments are pre-tax commitments. You can get a tax benefit from it, but we haven't netted it out. In fact, if I take my contractual lease commitments and convert them to after-tax form, right, multiply, then I can use the after-tax cost of debt. But because I'm looking at pre-tax commitments, I'm going to use the pre-tax cost of debt to discount it. Because once you decide to treat something as debt, the cost of debt becomes the discount rate. What I get as a present value is $4.4 billion for the gap, for projected future commitments. And it changes everything about the company. So what I'm going to start with today is to look at the impact that this has on the numbers of reuse and valuation. Because remember, my end game here is not to get the accounting right. Frankly, I couldn't care less. It's to make sure that the numbers I'm using in valuation reflect the truth about the company. In fact, this is actually from presentation I did for the Gap about 20 years ago when there was first talk about IFRS and Gap treating leases as debt, and retail firms were freaking out. They're saying, what the heck is it going to do to our numbers? So I was invited by the Gap to come in and talk to their finance group about how converting leases to debt would change the way I think about the Gap. And I have to tell you, before I show you the numbers, that they went through various stages of delirium as I presented what would happen. Initially, they were very happy, then they got incredibly depressed, and they got happy again, and then they were completely confused. And let's see why. I started with the good news. I said, look, right now, so this is the way accounting was pre-2019, leases were treated as operating expenses. You subtracted them out, and you had operating income for the gap of $1.012 billion. I said, the good news is if leases are not treated as operating expenses, they're treated as financial expenses, your operating income will go up. Why? Because you move some of that expense from above your operating income line to below, right? Because now it's a financial expense. So I said, the good news is you look more profitable, at least on an operating income basis. Your net income won't change, but your operating income will be higher. Happiness all around the room. I said, wait, before you start to celebrate, I have some bad news. With the conventional approach to treating debt, when I look at your balance sheet, I don't see much debt. I see 1.97 billion. But once I start treating leases as debt, that number is going to balloon out to 6.4 billion. So I'm going to treat you as a much more levered and risky firm after I capitalize leases than before, because I'm getting a truer sense of what you actually owe. So your operating income goes up, your debt goes up. Now, this was bad news. They were a little disappointed. I said, wait, there's still good news, because when your debt goes up, your cost of capital will actually go down, because now more of your capital comes from debt, less comes from equity. And since the cost of debt is lower than the cost of equity, your cost of capital go from 7.3% to 6.25%. Again, celebration again, higher earnings, lower cost of capital, things are looking up. I said, there's one final piece of this puzzle that you need to bring in. One way to think about how much value you create from growth is you look at your cost of capital, and then you look at what kind of returns you make on your projects. Good companies generate returns that significantly exceed their cost of capital. And the way we measure return on invested capital is we take the operating income after taxes, which is what I've done in the numerator here, and divide it by invested capital. It's one of the few places in finance where we go to book value. Before I capitalize leases, I had only $1.97 billion in book debt. So the invested capital was small, and my return on capital at the gap was 12.9%. Once I capitalize leases and bring them in, because I now have more debt, my return on capital decreases. At this stage, they were completely confused. They said, our income goes up, but our debt goes up. Our cost of capital goes down, but our return on capital goes down as well. What is the net effect going to be on value? Will value increase or decrease when you capitalize leases? What do you think the answer to that question is? Is there a way, is there a shorthand here I can use to gauge that effect? Because I'll tell you what's not going to happen. You can't tell them the value is not going to change, because then there's no point in doing this whole thing. Clearly, there has to be a value effect. Will it be positive, negative, or zero? Depends very much on the company. And I'll tell you the shorthand you can use. One way to think about the value of growth is the spread you make between your return on capital and the cost of capital. Before I capitalized leases, I thought the gap made a spread of about 5.59%, right? 12.9 minus the 7.31. After I capitalized leases, that spread has dropped to 3.05%. The gap is creating less value from growth than I thought it would. The net effect for the gap is that value decreased, but very slightly, because they weren't growing that fast. But if you have a high growth company, this adjustment is going to make a huge impact on how much value you see from future growth. And there are some companies where before you make the adjustment, they're actually making more than their cost of capital. But after you capitalize leases, it flips. They're actually making less. But 8 years ago, when Starbucks was opening stores like they were going out of style, you think they stopped that? I mean, clearly they're still opening stores, but they kind of sobered up a little bit. One of the things I did was I did this calculation because the conventional wisdom was Starbucks is a great growth company. It makes tremendous returns. So growth is a good thing. And before making the adjustment, it looked like they were earning well above their cost of capital. I made the adjustment and the number actually flipped. The return on capital became lower than the cost of capital. If a company is growing at 20, 25, 30% a year, opening new stores, and it's earning less than the cost of capital, it's on a fast train to a very bad place. In fact, about 8 years ago, Starbucks realized it. It took them a while, and they actually shut down expansion for a while. They tried to shut down stores, and they're running into another one of those brick walls again. But I think that's the reason you need to capitalize leases. It's not because I'm accounting, getting it right. It's to make sure you get a better sense of what this company does. And remember what I said about leases applies to any kind of contractual commitment. Netflix, those content commitments have to be treated like that. Any questions about leases? As I said, in 2019, accounting came to its senses. Because until 2019, I used to do this for every company. It sounds like a lot of work, but it's pretty standard, right? Because you download the commitments, you do the present value. I would convert leases to debt for every company. And when I reported debt ratios and returns on capital companies, it was with leases treated as debt. Because the lease commitments are those are the expenses you have before you get the tax. That lease payment, when you make it, will get you a tax advantage. So if I take the lease commitment and multiply by 1 minus the tax rate, that'll be good. So because the lease commitments are pre-tax, I use a pre-tax cost of debt. Otherwise, I'll be mismatching my cash flows, my discount rates. Now, I have mixed feelings about accountants coming to their senses because I'm glad they're doing the right thing now. But accountants never take the easy road to doing things. And it's not their fault. They get lobbied from every side. So the accounting rules that were written to convert leases to debt are a lot more complicated than my rules. My rule is you have a contractual commitment, I'm going to treat it as a debt payment. Accountants, and you could argue that they're doing a sensible thing here, look at how much flexibility you built into your lease commitments. And if there's enough flexibility built in, they will give you a break. They'll either use a shorter period of lease commitments or less lease commitments. I don't have a problem with that logic. But let's say you're the accounting rule writers, you put in, if you have this much flexibility built in, you write in all the escape clauses that will give you flexibility. We're going to not treat leases as debt. You know what companies are going to start doing, right? They're going to look at that and say, can we put that into our lease contracts? So one of the things you've got to watch out for when you do this, and you essentially look at what accountants have done, the numbers they're going to come up with are going to be different from mine, and generally lower, because they're going to allow escape clauses that I'm not allowing. At one level, you're saying they're being more realistic because they're building the flexibility. And you can see the number difference. Let's take the US, where I think you've seen the most significant shift towards bringing leases to debt onto the books. The accounting estimate of lease debt, and because now in the balance sheet, I can see it on S&P Capital IQ, if I add it up, is $949 billion. My estimate is $1.152 trillion. That difference of 200 million is my capturing lease commitments, which might be a little flexible as debt. But look at the difference as you go to Europe. In Europe, the difference is much bigger because there are parts of Europe still that are not covered by IFRS. The leases are not treated as debt, and there's even more flexibility. And if you go to emerging markets, it's huge. In emerging markets, I'm getting $109 billion in debt. According to the balance sheet, it's $18 billion in debt. There are a lot of emerging markets where lease commitments are still not treated as debt. And there are some emerging markets where companies are playing games to keep lease debt off the books, and it's only going to get worse. So my suggestion is, if there's lease debt on a balance sheet, don't just take it. But check and make sure that that lease debt is reasonable, because at least for the moment, companies are still reporting those commitments as part of the footnote. So you can see the commitments the accountants used. You can see that data, and you might say, look, I don't agree with the accounting estimate. I'm going to replace it with mine. Any questions? Now let's talk about R&D. Clearly, again, big in some sectors, not so big in others. So what I've listed here are the sectors which have the biggest R&D expenses as a percentage of sales, and no surprises, right? A lot of pharmaceuticals, a lot of technology, and the sectors where R&D is the least of an issue. If you're valuing Coca-Cola, I don't care whether you capitalize R&D or not, there is no R&D to worry about. Same thing with Kraft Heinz. But if you're valuing Pfizer, this is going to be a big deal. So again, let me make my case for why R&D is really super Capex. Goes back to that definition of Capex as any expense designed to create benefits over many years, and R&D is ultimately Capex. So I have to capitalize R&D. There is really no question about it. The real question is why accountants are so resistant to capitalizing R&D, and the answer is actually goes back to that uncertainty issue. They make a big deal about the benefits are uncertain, therefore we don't want to capitalize it, which makes absolutely no sense. Because if you're, let's say, a steel company and you build a plant, are your benefits certain? Absolutely not. Uncertainty is a continuum. There are no guaranteed projects, and you can't draw a line and say, if this is more uncertain, then we're going to treat it as an operating expense. So that excuse falls flat. The other fallback that accountants use for why they expense R&D is they want to be conservative. You know what they mean by conservative? We expense it, the income is lower, and lower income is a conservative estimate. What's wrong with that? Here's what's wrong with that. If you expense something, it doesn't show up on the balance sheet. When you expense R&D, you've taken your biggest assets off the books. So when I look at your balance sheet, I'm getting a very misleading view of how much you've actually invested in the company. You know what this is going to do, right? It's going to push up the return on equity and return on invested capital at technology companies and pharmaceutical companies, make them look better than they really are. So at least I'm going to set up the process for capitalizing R&D. First step in the process is I have to make a judgment on how long it takes between the time you spend money on R&D and a commercial product emerges from the R&D. Notice how I threw the on average up front? Because I know some R&D will not pay off. Some might pay off in 8 years, some in 5, some in 3. But on average, give me an estimate. Let's suppose you tell me it takes 5 years for R&D to pay off. Here's what I'm going to do. I'm going to go collect your R&D expenses every year for the last 5 years. You're saying why? Because if I tell you R&D takes 5 years to pay off, and I've been capitalizing R&D all the way through, you know what the logical thing to do, right? So if an R&D expense, instead of expensing it in that year, I'm going to spread it out over 5 years. And I'm going to keep track of two numbers. One is how much my collective writing off of previous year's R&D, let's call that amortization of past year's R&D is this year, and what's left that hasn't been written off. I know it sounds incredibly abstract, but let me give you an example. You heard of SAP, it's a German software company. It competes with Oracle and Salesforce, sells business software. Now, typically when I value software companies, I assume 2 to 3 years before R&D pays off its products. I mean, Microsoft, when it invests in R&D, it's not expecting a product 10 years from now. But with business software, the lead and lag time is a little longer, so I'm going to allow for 5 years. So the R&D expense for the most recent year is $1.02 trillion. I know one thing about, I want to emphasize here is when we talk about the most recent year, that most recent year ended as of let's say 15 minutes ago. So the most recent year runs through today. You're saying, so what? So when I tell you the most recent year's expenses, you wrote that check 15 minutes ago. It's been just spent. If you've just spent money, you can't depreciate it right away. So the depreciation always starts with the -1. So basically, I'm going back in time all the way to year -5. Let's take the expense from 5 years ago, 744.47 million. If I've been consistent all the way through, you know what I should have been doing with the 744.47? I'm writing off 1/5, 1/5, 1/5, and the last 1/5 is being written off this year, and there's nothing left. The R&D from 4 years ago, 969, I'm writing off 1/5, there's 1/5 left over. R&D from 3 years ago, I'm writing off 1/5, there's 2/5 left over. It's not rocket science, but every year I look at the 1/5 I'm writing off, what's left over. If I add up the last column, I get 903 million euros. That is what I'd be amortizing of previous year's R&D expenses if I've been capitalizing R&D all the way through. If I add up the second to last column, I get 2.9 billion. You're saying, what does that tell me? It's the capital I've invested in R&D that's now going to show up in my balance sheet as an asset. When I described this, I actually had to do this for an AICPA conference. They jumped on me and said, you're giving credit to the company for something that might not pay off. This is the problem with accountants. They think putting something on the balance sheet is giving credit to a company. When I put something on a balance sheet, I'm holding the company accountable because I don't value companies based on what's in the balance sheet. I look at what they make as earnings based on what they have in the balance sheet. So by putting the 2.9 billion in the balance sheet, I'm telling the company, look, I know you've spent a lot on R&D, but I'm going to look at your earnings to see if that investment was justified. This is about accountability. And this now shows up on the balance sheet as an asset. So let's actually trace out, just like I do with leases, how capitalizing R&D affects the numbers for a company and why it might affect evaluation. Let's start with operating income. SAP's operating income based on conventional accounting, where you expense R&D, would have been $1.285 billion in after-tax operating income, $2.025 billion in pre-tax operating income. So if I trusted the accountants, that's what the operating income looks like. But if I capitalize R&D, here's what I need to do. I need to remove R&D expenses from the operating expenses, so add it back. But I have to depreciate the asset I create with that R&D. Remember, when I create this asset of 2.9 billion, that 2.9 billion has to get depreciated in future years. So basically, I'm adding back the R&D and I'm subtracting out the amortization. So the 903 million is subtracted out. I'm adding back the R&D expenses. My adjusted after-tax operating income is higher than it was before I capitalize R&D. For most technology and pharmaceutical companies, this is exactly what you will see happening. You capitalize R&D, they're going to become more profitable than they were before you capitalize R&D for an obvious reason. You're taking a big expense. There was an operating expense, and part of it into a capital expense. Don't celebrate too quickly. I'm not giving them any kind of benefit by doing this, because increasing earnings is only a piece of the puzzle. Let's see what else changes. If you look at the balance sheet, before I capitalize R&D, I thought their book value of equity was only 3.8 billion. After I capitalize R&D, it becomes 6.8 billion. They really have much more invested in book equity and invested capital than I thought they would. If you look at the capital expenditures, I thought they invested nothing because their traditional Capex was 2 million euros. But if I capitalize R&D, that's going to increase to 119 million. Essentially, I'm treating R&D as a Capex and treating amortization like depreciation. So my net Capex goes up. So here's what I have. The company is more profitable than I thought it was, has more invested than I thought it did, is reinvesting more than I thought it did. And if I compute the free cash flow, and this is what mystifies people, the free cash flow remains exactly the same after I've done this dance. And then the question is, why are you wasting your time? You're getting the same free cash flow whether you expense R&D or capitalize, and I'll tell you why I'm wasting my time. When I look at the free cash flow, I'm getting a final cash flow. But does it matter whether you got to that cash flow, the high operating income and a high reinvestment, and a low operating income or low reinvestment? I think it does. Because if I get to a cash flow with high operating income and high reinvestment, that's telling me something about the future. Right now, by expensing R&D, we've lost our capacity to hold technology companies and pharmaceutical companies accountable for all that money they pour into R&D. You know how much more valuable Merck would be as a company today if they hadn't spent the $100 billion in R&D that they've had over the last decade? Because there's very little to show for it. Their earnings haven't gone up to reflect that investment. We're giving companies a free pass now because of the way we treat R&D, and we need to stop because it's allowing game playing on the part of technology companies and pharmaceutical companies to make themselves look better than they truly are. Any questions about the capitalization and the effects it has on valuation inputs?
Okay.
Somebody in Zoom, go ahead.
Everything's fine. I wanted to make sure my man got a nice home.
I think you might want to mute yourself. I don't think that was for me. Go ahead. I'm sorry. Oh, this 1402? Yeah. Basically, it's a 1402 right here, right? So basically, what I'm allowing for is right now the way we companies are allowed to treat R&D gives them a tax benefit. Because instead of just subtracting out the depreciation part of the amortization, so that's what the extra 43 million is. So the 1402 is the correct after-tax operating income with the tax benefit built in. Okay. Now, again, as with leases, it's just the start of a process, right? With leases, we said any other contractual commitment should be treated essentially as debt. With R&D, again, this is just the tip of the iceberg. You think about consumer product companies, you could argue that their operating income is understated because we're expensing all of the advertising. Their book equity is understated because we're doing the same thing. And in fact, if you look at the bottom line here, here's the reason it matters to me. Before I adjusted for R&D, I thought the return on capital at SAP was based on their book equity, but that book equity is much smaller. So the return, the number seems to have dropped. I was about 24%. After I capitalize R&D, the return on capital is 18%, still impressive, but not as impressive as it looked on the surface. When you look at my website, I report returns on invested capital and returns on equity for every sector. I've capitalized R&D for every company. I use some bludgeon assumptions because you can't do this. You can't finesse it with 46,000 companies. But I do it because I want to get a clearer sense of what the excess returns are by sector without skewing the numbers by allowing accountants to expense all of the R&D. The last decade, you've seen the rise of the platform company, right? Companies with platforms of users, subscribers, and writers. You know, the equivalent of R&D is something that's being expensed right now that we should be capitalizing with these companies. Think Uber, think, Airbnb, what is it? Acquiring customers, right? In fact, many of these companies, a third of their costs are spent acquiring new customers by giving them special deals, by offering them free services. That's really Capex. I'm going to take it out, which will make these companies more profitable. You think that's not right. You shouldn't be doing that. I'm going to now hold them accountable, saying you're spending billions on customer acquisition. Where's the payoff? How long do these customers stay on? Which means that we'll then ask questions about, renewal rates, and you need to sign up a new customer. How long do they stay on your platform? Questions we should be asking about these companies that we're not right now because of the way we're measuring income at these companies. So now we've talked about updating numbers. We've talked about cleaning up for accounting. And there's a lot of cleaning up. I've just used leases and R&D as an entree to talk about all those expenses that are being miscategorized right now. Let's talk about extraordinary expenses, one-time charges. You know what? There's a lot of accounting gameplay going on. I just remember in the late 90s and early part of the 20th century, or the 21st century when we got in, it got to the point where, analysts would look at a company's earnings, And they would call it EBBS, earnings before bad stuff, because companies got really good at taking bad stuff and moving it below the line. So they say earnings before bad stuff was 6 billion. By the way, there was a lot of bad stuff this year. By calling an expense extraordinary or one time, here's what they hope you will do. They will hope you to ignore it, saying it's extraordinary, it's not going to happen again. So let's play a little game. Let's assume we have a company which has reported a $500 million loss, and that entire loss is because at a one-time charge of $1 billion that year. So here's the easy question. If it was truly a one-time charge, when you sit down to value this company, what are you going to use as your base year's operating income? Would you stay with the $500 million loss because that's what they reported? But it's a one-time charge that's really just last year, right? And your job is to project out the future. So you know what you're going to do? You're going to add the entire billion back and act like this company made a $500 million profit. It sounds like you're blind to a loss, but it's gone. It's a one-time charge. It's in the past. So if it's truly one-time, truly extraordinary, I think you're well-merited looking at the income you would have had before those charges. I'm already laying the groundwork for some of you who have money-losing companies to have an easy pathway out of there. If your losses in your company came from something that happened last year, that's now behind you. And for a lot of your companies, you know what that bad thing that happened last year that's now behind them is, right? It's COVID-related charges, and you truly think this is it, we're done. You can just add that expense back and look at the income you'd have had before the expense, and there your loss might become a profit and you're done with the problem. But be careful, and here's why. Let's suppose you look at your company. It's got a $500 million loss and a $1 billion one-time charge. And then you start looking across time. And you notice that every 5 years, this company has a one-time charge of $1 billion. You should be suspicious. You know why? Because it looks to me like this company is playing a game of taking something that's a regular operating expense, bundling it up and claiming a one-time charge every 5 years and hoping that you ignore it. Now, I know, many of you have already signed up for S. One of the nice things about S&P Capital IQ is you can download historical data on your company for as long as it's been around. So you can say, show me the entire historical data. I don't use all of that historical data, but one of the things I'm looking for are things like extraordinary charges that might show up every 4 or 5 years, because that gives me a clue of, hey, what do I do with this charge? In fact, let's take this example. Let's assume that you have $1 billion charge every 5 years. What did I say? That's really like a $200 million expense a year that's been bundled up, right? The company is reporting a $500 million loss because of this charge. Now, it was truly one time we added the entire billion back, saying the income was 500 million. If it's a one-time charge that shows up every 5 years, what would you add back? You don't want to add the entire billion back, right? You'd add 800 million. Why? Because 200 million of that should have been in this year's expense, which will give you a $300 million profit. It's very simplistic. I'm just saying, if you have charges that show up once every 3 or 4 years, just average the charges out, act like they happen every year when you compute the operating income, because it just might be game playing on the part of your company. Any questions on one-time or extraordinary charges? Now I want to get into a tricky area. We trust accountants, right? We might not respect them, but we trust them to deliver what they were supposed to do. And sometimes that trust is misplaced. What am I talking about? I'm talking about accounting fraud. When you value a company, there's accounting fraud. You're screwed. There's really very little you can do, because if they're just messing with the numbers, you can have every mechanical detail right, but your valuation is built on a mirage. 25 years ago, people assumed that this didn't happen in developed markets. It happened in emerging markets. And then in the late 90s, we discovered it happens everywhere. In fact, there's a branch of accounting called forensic accounting that came out of the late 90s. You know what forensic accounting does? It goes through annual reports of financial statements looking for clues that there's fraud. I'll give you one very simple, there's a whole series of tests. In fact, I'll send you links to a couple of books you can read on forensic accounting. If you're interested, they're actually readable. Most forensic accounting books are just impossible to get through, but these are actually readable versions. So they say, look for these clues in your company, because you see those clues, you should get skeptical, you should get suspicious. Here's one. You know how in an income statement, you get a measure of income, right? That's accrual income. Accrual income based on the fact that in accounting, it's not cash accounting, it's based on when transactions happen. So accrual income is what you see in the income statement. If you go to the statement of cash flows, you can come up with a measure of cash income. You take the net income, you adjust for change in working capital. So you have accrual income and you got cash income. And for companies, the two numbers will almost never match. Some years one will be higher, some years others will be higher. But if you have a company that year after year reports accrual income that exceeds cash income, it's not complete proof that something strange is going on, but you should get suspicious. If you see effective tax rates go from 23 to 27 to 25 to 21, that's completely expected because effective tax rates vary. But if you see effective tax rates go from 23 to minus 11 to plus 47, there's something strange going on. Notice I said something strange. I didn't say it's fraud automatically, but that's what forensic accounting is designed to do, is look for clues that your company is playing games with you. In some markets, you have to do this. And sometimes you have to look at who runs a company. If you don't trust them, you're going to start with the presumption that they are playing games and try to see how do those games play out in the numbers that I see for the company. So I wish I could give you a magic bullet that says, if you do this, everything's going to be cleaned up. With fraud, it's buyer beware. You got to basically go through the numbers, say, if I don't trust the numbers, where would I find the clues? And forensic accounting is offering us some direction on that. Any questions about malfeasance, accounting malfeasance and fraud? Hopefully none of your companies are doing it. Or if they do it, by the time it comes out, the semester is over. The worst thing for you would be to pick a company on May 5th, there's a news report that says, the company's been cooking its books. I would just ignore the news report, act like it's not even there. Because if the news report is right, everything you've done has been built on a foundation of sand. Last item, and I've kind of started on this. As I said, at least 1 out of every 5 people in this class is valuing a money-losing company. How do I know that? Because every group has at least one person who should be doing a money-losing company. My guess is probably more than that, because all the exciting companies now are money-losing companies. If you're a money-losing company, of course, your path just got a little more difficult, or a lot more difficult than you're a money-making company. You're saying, what do I do? So let me offer some direction. And to give you this direction, I'm going to ask you a question that's going to sound incredibly stupid, but humor me anyway. I'm going to ask you, why is your company losing money? And you might say, that's because my expenses exceed my revenue. I know that's the technical reason, but what's causing it? And let's look at the possible reasons. One is, remember I talked about one-time charges? Maybe your company is a hotel company and it just took off a big charge from last year because of leftover effects from COVID. That is the easiest problem to fix, because you just add the expense back and say, this is what my income would have been before the expense. It could be because your company is a cyclical or a commodity company and last year happened to be a bad year. So anybody who picked an oil company in the spring of 2021 to value in this class had negative earnings. Why? Because during 2020, if you remember, oil prices collapsed during COVID. It kind of blew up the earnings for every single oil company. If it's cyclical or commodity related, the fix for that is to normalize, because you look at 2020, you look at 2019, you look at 2018. So the easy problems to fix are either one-time charges or cyclicality and commodity related. Let's look at the more difficult ones, because these are longer term. Your company might be losing money because that's where it is in its life cycle. If you're looking at an Airbnb or Palantir, they're losing money not because they're bad companies, but because they're still young companies. A company could be losing money because it has structural problems. Its production facilities are old and need to be fixed up. It's got labor contracts that need renegotiation. You see where I'm going with these companies, the fix is not near term. It could take a while. Don't take these companies and fix it next year. Don't take your losses and make it profits, because that's not the way this is going to unfold. So with these companies, what you're going to do is you're going to pick a target margin. Basically, you're saying right now they're losing money, but once they become healthy, this is what I think they can make as a percentage of revenues. You think that's going to be difficult to do? I agree. If it were easy, everybody would be valuing these companies. The reason people give up on these companies is because they don't want to do that. So when we value young companies, that's one of the numbers we're going to focus on. How do we come up with the target operating margin for an Airbnb or an Uber? Because without that, you really can't value companies. And finally, there are some companies that are losing money because they have a lot of debt. You know how you can tell? Their operating income is a nice, healthy, positive number, but their net income is negative. There, the fix is fairly simple because you got to bring your debt load. It's really got nothing to do with operating assets being bad. It's got to do with the fact that you have a lot of debt. So in your valuation, you got to figure out a way to make the debt ratio become a more reasonable number over time for this company to make it to being a healthy company. So you can already see that the way you treat a money-losing company is going to vary across money-losing companies. So 3 of you within a group have all got money-losing companies. Compare notes, because it might turn out that each of you has to use your own way of getting to positive earnings. Because each company is different. Any questions on money-losing companies? So now we've got the operating income. It took us a lot of cleaning up to do. One-time charges, accounting, miscategorization. So let's say you got the operating income for your company. You got to multiply that operating income by 1 minus the tax rate. And here are your choices. You can use the effective tax rate. So I said that most financial statements, that's what you report, which is taxes paid divided by taxable income in the income statement. So it's accrual taxes divided by accrual taxable income. That's the effective tax rate. You could use a tax rate based on actual taxes paid and operating income, taxes paid divided by operating income. I don't even know what to call it because it's some middle rate. You could use the marginal tax rate of the country in which your company operates. So if you're a US company, you'd be using 25 or 27%. An Indian company use 34% or 33%. Brazil, 34%. If you're a multinational, maybe you should be using a weighted average marginal tax rate of all the countries that the company operates in. Maybe it's none of the above, in which case I'd love to hear what you'd use instead. Or it'd be nice if the last choice were the right choice, which is use any tax rate you want as long as you're consistent. I'll tell you upfront, that's not going to work, because if that were true, you know what tax rate we should use to value every company? What's the easiest tax rate to work with in valuation? A zero tax rate. Just assume no taxes. If all you have to do is be consistent, just ignore taxes. Clearly, that can't be the answer, because then we'd be ignoring taxes right from the beginning. So really the choice becomes, do you want to use an effective tax rate or do you want to use a marginal tax rate? So let's take an example. Let's suppose you have a company which has an effective tax rate of 15% right now. It's a US company. Gets a bulk of its income or almost all of its income in the US, and that's going to be part of the story. And the marginal tax rate in the US is 27%. How does a company end up with an effective tax rate so much lower than the marginal tax rate? This is not unusual. In fact, you look at the effective tax rates I report by sector. I think they vary from 11, 12% to 24%, but I think there are only a couple of sectors where the effective tax rate is higher than the marginal tax rate. Most sectors, and for most companies, the effective tax rate is lower than the marginal tax rate. What are the reasons for effective tax rates being lower than the marginal tax rate? Yes. No, remember, it's taxable income. Taxable income is already after interest expenses. So debt can't explain it away because it's, we've already netted. So if I divided taxes by operating income, you'd be right, because then interest, but here I'm dividing taxes by taxable income. Debt can't explain it. One is you could find tax deferral ways, right? Remember, the key word is tax deferral. It could be, tax planning. You can buy assets that give you a temporary relief. You're deferring taxes. The essence of deferring taxes is eventually you catch up to the tax rate. If the reason the effective tax rate for your company is lower than the marginal tax rate is because it's very clever deferring taxes, here's what I think you should do. I think you should start your valuation using the effective tax rate. They're still clever, they still pay low taxes, but as you go through time, what should happen to your tax rate? Remember, as you go towards terminal value, growth rate, remember these games you can play much better when you're growing fast. As your growth slows down, you're going to find it more and more difficult to play these games. Mature companies, if you look at my US database, have effective tax rates much closer to the marginal tax rate than growth companies. So if you have a company where the reason effective tax rates are lower than marginal tax rate is they have really good tax lawyers, then I have no problem with you starting with 15% in year 1, year 2, year 3, year 4, even year 5. But as you get closer and closer to year 10, which is where you have your terminal value, you should probably push your tax rate up towards the marginal tax rate. Now, if you choose to do a weighted average marginal tax rate across countries, all the more power to you. That's what you want to do. But you should be moving towards a marginal tax rate. In the US, though, there's another reason effective tax rates can be lower than the marginal tax rate. Since 2017, the US has caught up with the rest of the world. The way companies get taxed on income is based on, US income gets taxed at the US tax rate. European income gets taxed at the European tax rate, with different countries having different tax rates. Asian income gets taxed an Asian tax rate. So if you're a US company with a lot of revenues outside the US, especially in markets which have much lower corporate tax rates, Hong Kong, for instance, only 15%, your effective tax rate can be lower than the marginal tax rate, and that difference is not going to go away. Apple has a 16% effective tax rate. Some of that is tax deferral, but some of that is permanent because they get their income in countries with lower tax rates. I said since 2017. You know what the law was pre-2017 for US companies? One of the most insane types of things I've ever seen written into tax code. What is the law in US companies pre-2017? That if you made income in a foreign market, you had to pay the foreign taxes, obviously. But then when you brought the income back to the US to pay dividends or buybacks, guess what you had to do? You have to pay the differential tax rate. Insane for the following reason. You tell companies, look, you will get taxed on that margin, the additional amount, when the money comes back to the US. Guess what these companies chose to do? They left them outside. It was called trapped cash. You're saying, how big can it be? At its peak, there were $2.5 trillion in cash trapped in markets outside the US. Because those companies wouldn't bring it. Apple alone had $200 billion of its cash balance trapped. So one of the things that 2017 tax law did was it allowed that cash to come back. Because that's a healthy thing to do. Leaving it trapped in markets outside basically means it's frozen in place. And the reason I said finally the US caught up with the rest of the world is the US and 5 other countries. And I don't want you to even look at the names of the 5 because you don't want to be hanging out like Estonia. It wasn't the greatest group to be hanging out with. Had this system of we're going to tax you on all of your income at US tax rates. I would get some emails from Estonians. Don't take it personally. So I don't even, you hang out with Estonians. I'm sure they're nice people to hang out with. Yeah. So any questions on effective versus marginal tax rate? So the bottom line is start with the effective tax rate and move to the marginal tax rate for most companies, unless you feel that this is a permanently lower effective tax rate. Yeah. Just use the effective tax rate. So for Apple, or at least don't move it all the way to marginal. You might say, look, it's 16%. Over time, I'm going to move it to 20%. The other things that happened post 2017 is you're getting a convergence of marginal tax rates in much of the world. You still have outliers in both directions, right? You have countries like Brazil with 34% tax rates, higher than the norm. The norm is now around 25%. And there are countries like Ireland, which have tax rates lower than the norm, but the pressure is building on those countries to move towards the middle. For the higher tax rate countries, the pressure is coming from companies saying, hey, we're going to move to lower tax rate countries if you don't change your tax rates. For the lower tax rate countries, it's coming from their peer countries. Ireland is under an incredible amount of pressure from the rest of the EU saying, this is unfair. You're having a 12.5% tax rate. You claim to be part of the EU. So it doesn't mean that overnight the tax rate is, but one of the pieces of good news here is the marginal tax rate that I think are going to converge around 25%, especially with the most recent changes they're talking about catching companies that are paying effective tax rates much lower than the 25%. Yes. Yes, because it's not just here, right? So if you think the marginal, but remember that they use the marginal tax rate right from the beginning. So unless you feel the marginal tax rate is going to change, there's nothing to change in your cost of capital. But if you feel the marginal tax rate is itself going to change, remember briefly this last year, there was talk of the US corporate tax rate going up to 28%. So you say, if that's going to happen, then I'm going to use a 30% marginal tax rate 2 years out or 3 years out. So yeah, everything can change every year if that's what you feel about taxes. A little tweak on money losing companies. When you lose money, obviously you don't pay taxes. Thank God for that. But when you lose money, the government does give you the benefit of taking those losses and carrying them forward. In the US, you can actually carry them forward or carry them back if you have made income in previous years and get your tax benefit. If you carry them back, not an issue, but if you carry them forward, it creates what's called a net operating loss or an NOL. So let's take an example. Let's suppose you have a company which has an NOL of $1 billion from losses in the past. It's expecting to make money for the next going forward. In fact, it's expecting to make $500 million every year for the next 3 years. I've made them numbers, nice round numbers. You don't need a calculator to work this out. Given that they have $1 billion in NOLs leading into year one, let's assume the marginal tax rate is 40%. How much will they pay in taxes in year one? What does the NOL allow them to do? It allows them to offset what they have paid in taxes. In year one, they have no taxes. When you use up the $500 million, you have a $500 million NOL left over. Year two, no taxes. Year three, you're going to see a 40% tax rate. Here, the cost of debt will have to change. In years 1 and 2, when I do my cost of debt, I'm going to have a 0% tax rate. Why? Because there's no tax benefit in year 1, no tax benefit in year 2, and in year 3, the tax rate that I use to compute the cost of debt will be 40%. It's another issue with money-losing companies is the tax rate you use to get your cost of debt shift over time depending on how much you bring in as NOLs. In all of my spreadsheets, one of the things I ask you for is how much NOL does your company have leading into this valuation? Because if you're a money-losing company, not only do I have to keep track of that, but every time you lose more money, guess what happens to the NOL? It gets bigger. And then you use it to offset income over time. It builds your tax benefits into your cash flows. Now you got EBIT, you got this tax rate, you got after-tax operating income, all this work to get the first line of free cash flow to the firm. Remember, from that, you subtract out net Capex. Net Capex is the difference in capital expenditures and depreciation. Before we go into the mechanics of computing net Capex, let's talk about the kind of general principle you need to follow. If you ask me, how much net Capex should I put into my company? Before I answer that, I'm going to turn to you and say, how much growth are you giving this company? So let's start with the basic proposition. The more growth you want to give a company, the more net Capex you should expect to see in this company. Now, obviously, some companies might be more efficient than others, but higher growth and higher net Capex should go together. One of the things that drives me crazy sometimes when I watch bankers sit down, change the growth rate in earnings and leave the net Capex as a fixed line item. If you do that, growth is like a gimme, right? Every time you increase your growth rate, your value will always go up because you're getting a higher growth rate from the same net Capex. So if you change your growth rate, you have to revisit your net Capex and ask, is this a sufficient net Capex given my growth ambitions? So having said that, let's go back and shred the accounting definition of net Capex. Most people, if you ask them, what's your net Capex, they'll go to the statement of cash flows. And under the investments, they will find a Capex line item. And under the operating part of the cash flows, they'll see depreciation. So the accounting net Capex is based on what you see in the statement of cash flows. We've already talked about how that misses a big chunk of net capex, which is what you have in R&D and customer acquisition costs. So the first adjustment you need to make is for net R&D, whatever that is, net customer acquisition costs. But there's another item that we consistently tend to miss in valuation. When a company is in a hurry to grow, instead of investing in projects or in customer acquisition or R&D, you know what they do, right? They go out and do an acquisition. Now, how much did this year when I value Microsoft, you know how much I'm going to show in CapEx? A huge amount. Because in that CapEx, I'm going to include the $70+ billion they spent on Activision Blizzard. I'm not punishing Microsoft. I'm saying, look, you invested in my Activision, so your cash flows will reflect that huge CapEx. Here's what I hope you will give me in the future to make up for it. Much higher growth from being in the metaverse and the gaming platform you've built. But acquisition should also be part of net CapEx. Now, of course, there are two ways you can do acquisitions, right? You can pay with cash or you can pay with shares. And I've seen analysts ignore acquisitions that are paid with shares with this kind of strange argument of it's not a cash flow. I'm going to make a statement. This is going to be something I come back to over and over again. If you pay with stock, whether it's for CapEx or as compensation, you've just skipped a step. If you'd taken those shares, issued them in the market, you'd have raised cash and paid that cash, to be a cash flow. I cannot allow you to use a barter system to evade cash flows. So all acquisitions, whether they're cash acquisitions or stock acquisitions, should be treated as part of net capex. Our definition of net capex here is much broader than the accounting definition of net capex. And to show you how different the numbers can be, I'm going to take a company where it's perhaps the widest difference I've ever seen between net capex as computed by accountants and the net capex that I came up with. It was Cisco in 1999. For those of you who don't remember the history of Cisco, Cisco was one of the great success stories of that decade. Cisco started in 1990 with a market cap of $4 billion. And there was a brief period in 99. They were the largest market cap company in the world with a market cap in excess of $400 billion, $4 billion to $400 billion. And they did it with their own style. They didn't do projects, or R&D was kind of minimal. They did it by acquiring 10 to 15 companies every year. Many of them were private, many of them were smaller, many of them were technology companies. But their view was they would buy this promising technology and then they had the infrastructure to make it into a commercial product. It was immensely successful through the decade. This is actually from a valuation I did of Cisco in 99. And I wanted to see what their CapEx was in 99. And it turned out that in 99, they did 8 acquisitions. You notice it says method of acquisition, purchase, and pooling. Until the late 90s, US companies were actually allowed to account for acquisitions in one of two ways. In pooling, you brought the two companies together. So it's very similar to, in purchase accounting, you brought the two companies together. You showed goodwill as a difference. It's like accounting today for acquisitions. But until the late 90s, US companies were given this loophole of if you acquire a company entirely with shares, you don't have to show goodwill because there's no cash. So it allowed companies to do acquisitions almost under the surface. You didn't even realize they were doing an acquisition because they'd pay with shares, there'd be nothing on the balance sheet. So in 99, when I valued Cisco, the purchase transactions, and in fact, when you do cash transactions, they have to be purchase accounting. So I found those in the statement of cash flows. So these 6 acquisitions, there were 9 acquisitions, these 6 acquisitions I found in statement of cash flows because they were paying with cash. It's a cash outflow. It was under investing activities. But the pooling where they paid with shares, I had to dig through the footnotes. They gave the information, but it was hidden somewhere. Number of shares used in the acquisition. But if you look at the pooling acquisition, they were much bigger. But collectively in 99, Cisco spent $2.5 billion on acquisitions. To me, that's CapEx. And if I compute the cash flow for Cisco, if I believe the accountants, the net CapEx for Cisco would have been only 98 million. So that's a CapEx of the statement of cash flows and the depreciation, net CapEx of 98 million. But here are the adjustments I'm making. First, I adjusted for R&D. Remember what I did for SAP? I did the same thing for Cisco. I had back the R&D, subtract out the amortization. that adds another $1.1 billion to my net capex. Then I added the acquisitions, 2.5 billion. And all of a sudden, what looked like nothing, 98 million, has become $3.7 billion in net capex. Now, again, don't think of this as rewarding or punishing a company, because this is neither good nor bad. It's true, 98 million is a smaller drain on the cash flows, but I've left it at 98 million. The growth rate I would give Cisco would be much lower. The 3.7 billion is my net capex. That's going to make my cash flows look incredibly negative in the most recent year, but that's okay, because I'm going to give them the benefit of higher growth, presumably because they're doing these acquisitions, which might more than offset those negative cash flows. Any questions on net capex and how the accounting definition and the valuation definitions can diverge? So you're doing this for an Uber or an Airbnb, expect your definition of net capex to be very different than the accounting definition of net capex. So you've got EBIT times 1 minus T, you've got net capex. Let's close the loop by looking at working capital investments. Then the item that you actually see in a cash flow calculation is change in working capital. Now, if you think about working capital from an accounting perspective, I don't know how you were taught working capital, but I was taught working capital as the difference between current assets and current liabilities, right? That's the accounting definition. That is not the definition we should be using in valuation. The definition we should use for working capital and valuation is the difference between non-cash current assets and non-debt current liabilities. So what the heck are you talking about? Look at the current liabilities for a company. You'll notice things like accounts payable, supplier credit, but you'll also see things like short-term debt and short-term portion of long-term debt. Take those out of working capital because they're going to be treated as debt in your cost of capital calculation. You can't count something as debt and as part of working capital. So debt comes out of liabilities because it's really not part of working capital. It's part of debt. You're saying, why are you taking cash out of current assets? If you think about why working capital is a drain on cash flows, it's because it ties up cash. Inventory, classic working capital item. What's the problem with having a lot of inventory? While those items sit on your store shelves, they can't make you money. So when I increase my inventory, it drains my cash flows. When I sell items on credit and I don't collect right away, it drains my cash flows. So the question is cash a wasting asset? Does it drain your cash flows? There was a time when it was. 50 years ago, even US companies used to keep cash balances, big cash balances at banks. Banks loved it. Because in those days, the rate that banks could pay on deposits was actually capped by the US government. You couldn't pay more than 2%. So banks would collect all this money from deposits and then lend it out at 6% and make the spread. If you have to keep cash balances that are not making money, clearly it's a drain on your cash flows because while that cash balance sits around, it's doing nothing for you. The question about cash is it a wasting asset? To answer the question, you got to look at the returns you make on cash. If you're a US company and you show a cash balance, you know where that cash balance has to be invested? Something liquid and riskless. Right now, it's invested in commercial paper and T-bills. Probably making 0.1%. You're saying that is horrifically bad. If you invested in something liquid and riskless right now, you know what you'd make? About 0.1%. They make a low rate of return, but a fair rate of return. Cash is not a wasting asset if it's invested in marketable securities that earn a fair rate of return. So when you compute working capital, look at non-cash current assets and non-debt current liabilities, take that difference. It'd be very different from the total working capital difference. But think of Apple, right? You're taking $200 billion out of the working capital calculation, and you should be. It shouldn't be part of your working capital calculation because you're focusing on non-cash debt, non-cash assets, and non-debt current liabilities. So let's say you do this for your company. You do it for last year, the year before that. You're going to notice something about working capital that I've always found troubling. The first is it's volatile. You see big increases in working capital, big decreases. So on a yearly basis, the numbers can be all over the place. So my caveat is don't take the change in working capital in the most recent year and act like it's going to be the basis for your forecast because who knows what the most recent year looked like.
So here's a way around that. Instead of looking at the change in non-cash working capital in the most recent year, compute non-cash working capital as a percentage of revenues each year. It's a much more stable number. You're not going to get the swings you do with traditional working capital. And make that the basis for your forecast. So I'll give you examples again from way back in time, late 90s. Amazon, Cisco, and Motorola, all tech companies. Amazon then was a very young tech company. I computed the non-cash working capital for all three companies. Okay, so Amazon and Cisco actually had negative non-cash working capital. What does that mean? Your current liabilities, non-debt current liabilities, exceeded the non-cash current, and it was by design. The way Amazon ended up with negative working capital is it actually got books shipped to it on credit from publishers. It sold them to you and I, not on credit because you got the cash right away. And it played the game of, it had a float game where essentially it wasn't paying the publishers until 45 days or 60 days after it got paid. So the non-cash working capital at Amazon and Cisco were actually reflections of the businesses they were. Cisco, in fact, was in a sector where the average for the entire sector was negative, suggesting that in this business, software business, non-cash working capital, instead of being a drain on the cash flows, actually provides you with cash flows. You're playing the current liabilities off against the current assets and getting cash flows. Motorola, much more traditional company, had a non-cash working capital of 8.23% of revenues. When I was valuing each of these companies, one of the choices I had to make was what non-cash working capital will I expect to see in the future? For Amazon, over time, I assumed that their working capital would go from negative to positive. And here's the reason. Ultimately, Amazon wasn't the retail business then. I mean, remember all the other businesses Amazon is in now, they weren't in that. The retail business is traditionally a business where working capital is a big drain on your cash flows. I know Amazon has less of a need for inventory than traditional retailers. You know why, right? When I used to give the example, the old bookstore, the old days, I don't even know the last time you walked into a bookstore. We walk into a bookstore, and there are a few still left in the city. You notice there's a lot of show inventory. You know what I mean by show inventory? Books that are on the shelves because that's what bookstores are supposed to carry. Their entire philosophy section. Notice there's nobody hanging out in that section, but there are hundreds of books. And they all have dust on them because nobody's pulled them off the shelves. But you can't be a bookstore without that philosophy section. Even the investing section, most of the books are not touched, right? The Warren Buffett books and the rest of the books are all dusty. If you're a traditional retailer, you got to maintain a lot of show inventory. If you're Amazon, guess what you keep in stock? If everybody's buying Harry Potter, you keep lots of copies of Harry Potter. And if I ask for a book on philosophy, you say, maybe in 6 weeks, we got to get a guy to come in and write the book and then we'll mail it to you. It makes a difference. The average for the sector is 8.7. I'm going to give them a lower non-cash working capital because in their business model, even after they become a big company, they can get away maintaining less inventory. What I'm trying to say is just like everything else in valuation, there's a story you need to tell about non-cash working capital. If a company's business model is changing, it's offering more credit, that's going to show up as a non-cash working capital item. So look at your company's change in working capital, look at what it is as a percent of revenues, look at industry averages, and make your best judgment and move on. Don't get stuck here. It's just not worth the effort. So let's list out the items and if you have any questions. So start with operating income cleaned up for accountants, for one-time charges. Use a tax rate, preferably, you can start with the effective, but think about the marginal. Get net capex using the broader definition, include R&D, include acquisitions. And change in working capital, remember it's non-cash current assets minus non-debt current liabilities. And you might want to average out across time because of how volatile it is. All of that will give you a free cash flow to the firm. Now remember, the other way you can compute free cash flows is to equity. So let's at least start that process of how you compute free cash flow to equity. The most direct way to compute free cash flow to equity is look what the company actually pays out, actual dividends. And in a dividend discount model, that's exactly what we do, right? We stop trying to estimate cash flows. We said, that's what was paid out. I'll value the company on that basis. But the caveat I offer then is lots of companies don't pay out what they can afford to in dividends. In my corporate finance class, we talked about why. You've got your conservative companies, they might hold back cash. There might be companies that want to invest in new things. So let's talk about how you measure potential dividend. So the actual dividend you can observe, how do you measure potential dividend? There are some analysts who argue that earnings are potential dividends. Using this very loose logic, if the company wants to pay out all of its earnings as dividends, nobody can stop it. And that's true, right? If you do pay earnings as dividends, what's the only growth rate that is consistent with that assumption of all of the earnings being paid out as dividends? It has to be zero. Why? Because if you're paying out all your earnings and dividends, you're reinvesting nothing. That's okay. But don't tell me you're going to grow 10% a year. So if you're going to assume that earnings are dividends, the only growth rate that's consistent with that assumption is a growth rate of zero. You can't have your cake and eat it too. So I'm going to argue that if you want to get potential dividends requires that you work through what cash the company is left with after it's met every conceivable need. Well, like what? Net capex, change in working capital, debt payments. So when we talk about free cash flow equity, we're going to ask exactly the same question we asked when we did free cash flow of the firm, but we're now going to add layers of how much debt will the company have to repay? How much new debt will it take on? Which means free cash flow equity require a little more work, additional steps than free cash flow to the firm. So here's my free cash flow to the equity calculation. And in your mind, I want you to compare it to the free cash flow of the firm. When I did free cash flow of the firm, my measure of earnings was after-tax operating income. That operating income times 1 minus the tax rate. When I start free cash flow to equity, I start with net income. Think of why. Net income is after interest expenses. Free cash flow to equity is after interest expenses. Start with a different measure of earnings. Net capex, change in working capital, exactly the same definitions as I did free cash flow of the firm. But there's a new line item that I've got to factor in. Every time a company borrows money, think like an equity investor. When you borrow money, what happens? Money comes into the company. It's cash inflow. Every time you repay debt, it's a cash outflow. The last line item gives me my cash flows from repaying debt and from taking on new debt. That's my free cash flow to equity. The way I like to think about free cash flow to equity, it's a cash left in the till at the end of every year after you've done everything as a company. After you've reinvested, you've made your debt payments, what's left in the till is your free cash flow to equity. It's a cash you can take out of the company without hurting its operating future. Now, that's a pretty messy calculation because to do this now, I'm going to forecast out principal. And if you've ever seen an LBO model, a leverage buyout, you'll often see these line items because LBOs, you've got to figure out how much debt am I repaying each year, how much new debt am I taking on. But it's a pain in the neck. I hate doing it. So I'll give you a shortcut. And I'll tell you when you can get away using this shortcut. You start with net income, just like I did before. But instead of doing that full calculation of debt repaid and debt taken on, here's what I want you to do. Take the net capex and tell me what percentage of that net capex will come from equity investors. So I'm wearing my equity blinders. So look, 70% of my reinvestment comes from equity. I'm going to count only that because the rest is going to come from debt. So instead of having debt repayments and new debt issues, I estimate a debt ratio. And then I look at what percentage of my net capex and change in working capital, which is my reinvestment, comes from equity. What I have is my free cash flow to equity, but this works only if you're willing to make an assumption. The assumption is that from this point on, a certain percentage of your reinvestment is going to come from debt, and you're willing to tell me what that percentage is, 25%, 30%, 40%. So how do I come up with that percent? Remember in corporate finance, we talked about optimal debt ratios, so there's a right mix of debt and equity for your company. Maybe that's what you're going to use from this day. Maybe it's industry averages. But if you're willing to make that assumption, this shortcut works. So I'm going to close today by giving a very simplistic example of how this would play out. Now, this is a page that might kind of captures the difference in dividends and free cash flow to equity around the world. So there's my free cash flow to equity number. There are my dividends. And at least in 2021, dividends are actually greater than free cash flow to equity around the world. Kind of a troubling scenario. You can't keep this going. But basically, this is, the most critical part of this table is don't trust dividends. Not only can they sometimes be lower than free cash flow, sometimes they can be higher. So this is just computing free cash flow to equity for every company comparing to dividends and buybacks. And you can see dividends and buybacks are significantly higher than free cash flow to equity. That could change in 2022 or 2023, but companies are returning far more cash that's coming in. So let's talk about how this will play out. The example I'm going to use is an example that you might remember from corporate finance. Remember we looked at Disney? This is my free cash flow to equity for Disney in, I think, 1997. There's my net income, 1,533 million. The net capex was 612 million. But I'm going to take the shortcut. At least in 1997, I felt comfortable saying 24% of Disney's reinvestment is going to come from debt, the remaining 76% from equity. So I took 76% of my net capex, 76% of my change in working capital, gives me a free cash flow to equity of 704 million. That year, Disney's dividends were 345 million. Already you can see if I use a dividend discount model for Disney, I'm going to undervalue Disney. Their free cash flows equity are more than 2 times higher. But I want to focus on the free cash flow equity. It's driven by what percentage of my reinvestment comes from debt, right? What do you think would happen if instead of using 24%, if I'm getting, instead of getting 24% from debt, I got 30 or 40 or 50% from debt? As an equity investor, does that make your free cash flow equity go up or down when I use more debt to fund my reinvestment? Free cash flow equity is going to go up because I'm going to reinvest less and less equity because I'm using debt to make up the difference. This looks like a free lunch. In other words, as my debt ratio for Disney goes from 0 to 90%, my free cash flow equity gets higher and higher. Which means that if I take on more debt, I should become more valuable. My equity should become more valuable as a company, right? What am I missing when I look at just the cash flows? It's true, by using more debt, I will push up my free cash flows equity, at least on a per share basis. But as I push up my debt, what else is changing in this calculation that will affect the value of my equity? What do I discount free cash flows equity back at? A cost of equity, right? What goes into a cost of equity? A beta, risk-free rate equity and a beta. As my debt goes up, remember this is the beta for equity. What happens to my beta? It's going to go up. It's a levered beta. This is the other shoe that's dropping. As I take on more debt, my free cash flow equity is going up, but so is my cost of equity. That's why it's always a tricky call. You know, my earnings per share increase, my free cash flow equity increases, my cost of equity increases. I want you to think about what the final effect on value is. In fact, it ties back to what we did in corporate finance, which is increasing debt good for you? It depends on you as a company. There is an entire school of thought that says it doesn't matter, right? Do you remember that? What was that theorem, the theorem that says it doesn't matter how much you borrow? The Gliani theorem. In the Gliani theorem, it turns out that what you gain by using debt is exactly offset by what happens to your cost of equity. In the real world that we live in, where taxes matter and there is default risk, this can cut in different ways for different companies. But free cash flow equity is free cash flow of the firm with this added layer of debt. Okay, I'll see you on Wednesday. So don't come in late because you will miss time from the quiz. So please get in on time. Hi, how are you? Yes.
I'm so sorry to bother you with this, but I still don't have the rate. It's not that I'm lazy, I'm ready to
Well,
learn.
here's my suggestion. Pick a company and do it as an individual project. It's okay.
It's okay?
Yeah.
Oh, thank you so much,
Yeah.
because I tried to talk to more than 10 people,
Yeah.
and they have cool groups, and I tried to gather, the orphans, and I named everyone, I just got one except one, and the others, I don't know, and
Okay.
I don't know who they are.
Okay. Okay, so get started in your project. If at some point you do find a group, that's fine. But in the meantime, you'll be valuing your company anyway.
So I can choose any company?
Yeah.
Oh, thank you so much.
Okay. Yeah. Mhm. Okay. That's from the financial, that's actually the book value of equity at the gap. So that's why it's the same in both. So it's basically the book value of equity, which is uneffectively capitalized leases. Yeah, that's. Uh-huh. Yeah. Yeah. Oh. That's just take 612 times 1 minus the debt ratio. So the calculation in the brackets. Yeah, that's a calculation. That's actually, so if you take, so it says 76% of whatever the total net capex and total change in working capital are. Yeah.
And if a company wants to invest in a certain program, how to decide whether to use the cost of capital or use the cost of equity?
What about it?
I'm confused about it.
And then you need to go back and look at the notes because when we went over it, we actually had a weekly challenge on it. That's a fundamental thing, right? The cash flows are after debt payments, it's cost of equity. The cash flows are before debt payments, it's cost of capital. But if you're confused about it, I mean, you need to go back and review that because that's kind of fundamental. It's consistency, right? Cost of equity, you discount cash flows to equity. Cash flows to equity are after debt payments. Take the comparative, we just did free cash flow to equity, compare that calculation to free cash flow to the firm. Look at what's different.
Oh,
Yeah. But it's, but make sure you get that because if you don't get that, you have a serious fundamental problem. It's going to show up in all the problems that you try, which are based on that. Okay.